The all-weather portfolio has a boring reputation. That is the point. Since late 1971, the live BestFolio backtest shows about 7.66% per year with a worst drawdown of 22.48%. The S&P 500 compounded faster, but it also fell more than 55% at its worst. All-weather is not trying to win the party. It is trying to keep you invested when the party turns into a panic. Most portfolios are secretly one big bet on growth. They look diversified because they hold many funds, but when stocks crash, everything that depends on optimism falls together. The hard part is not understanding that risk exists. The hard part is sitting through it with real money. A 50% drawdown asks you to double your money just to get back to even. Many investors do not fail because their math is bad. They fail because the path is too painful. Ray Dalio's all-weather idea is simple: build a portfolio for different economic seasons. The retail version of BestFolio holds 30% United States stocks through SPY, 40% long treasury bonds through TLT, 15% intermediate treasury bonds through IEI, 7.5% gold through GLD, and 7.5% broad commodities through DBC. It rebalances once a year. No forecast, no monthly signal, no heroic market timing. Here are the live numbers as of July 6, 2026. Annual return, 7.66%. Volatility, 6.82%. Sharpe ratio, 0.98. Sortino ratio, 1.50. Worst drawdown, negative 22.48%. That is the number I care about most. All-weather did not beat stops on raw return, but it dramatically changed the ride. Lower return, much lower stress, and a smoother survival curve. If you put $100 into the reconstructed all-weather portfolio in late 1971, the live headline return ends near $5,586. The S&P 500 ends much higher, above $23,000, but the road is completely different. In 1974, stocks were crushed, while all-weather held up far better. In 2008, it bent but did not break. In 2022, the bond shock finally hit hard, and that became the real maximum drawdown. The mechanism is not magic. Stocks are the growth engine. Long bonds and intermediate bonds are the recession and disinflation ballast. Gold and commodities are the inflation sleeve. The weights look odd because this is not capital parity. It is trying to spread economic risk. Stocks are volatile, so they get only 30%. Bonds get more capital because their daily moves are usually smaller. Commodities get less capital because they are noisy, but they matter when inflation becomes the main problem. Now the honest part. All-weather can lag badly in long stock bull markets. It owns a lot of bonds, so rising rates can hurt. 2022 proved that stocks, bonds, and commodities can all be ugly at the same time. The backtest before modern ETFs also uses proxy data, especially for long bonds and commodities. So treat the deep history as useful, not sacred. This is a resilient allocation, not a guarantee. The crisis pattern is the reason people still study this portfolio. During the dot-com crash, the S&P 500 fell nearly half from peak to trough, while all-weather had a much smaller decline. During the global financial crisis, stocks lost about 55%, while all-weather stayed closer to a mid-teens drawdown in the local replay. COVID was fast and violent, but diversification helped again. The weak spot was 2022, when the worst drawdown reached negative 22.48%. All-weather is for investors who care about staying power more than bragging rights. It fits people who know they might panic in a deep stock crash. It can fit retirees and pre-retirees who care about sequence risk. It can also fit a core sleeve for someone who wants fewer decisions. It is probably wrong for investors who want maximum long-term growth and can calmly survive a 50% stock drawdown. You can inspect the all-weather page on BestFolio, compare it against other portfolios, and see the exact allocations, return, volatility, Sharpe ratio, and worst drawdown. The key number to remember is negative 22.48%. Not tiny, not painless, but very different from owning only stocks. Subscribe for the next portfolio breakdown and use BestFolio to compare the path before you trust the headline return.